Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager of trading and derivatives education here at Schwab, and this is investing in dividend stocks. And if we look back over the last few weeks, the first few weeks of 2026, there's been an apparently pretty strong, significant shift in the way some stock investors are behaving with their portfolios, and it's having a big impact on dividend stocks. So I was asking myself the question this morning. Could this be the year of dividend stocks? Could 2026 be the year of dividend stocks? I want to talk about this apparently major shift that has been happening. We'll talk about is it possible that it could continue to happen, and how might we follow that? And we're going to be planning and placing an example dividend stock investment trade today. So a lot to cover. I think this is going to be an interesting discussion. I'm really looking forward to it. But before we can get to that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Always nice to see the familiar names. Always nice to see somebody new. But hello there, Victor and China, Eva, Tatiana, JDLMI, Life in the Fast Lane, John. Let's see, who else is here? Rojo, Scott, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are among those that are here for the very first time, welcome. It's great to have you here. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But if you'd like to be in our live audience, this is a Thursday webcast series, and we kick things off promptly at noon Eastern time. Love to have you here. Now, I also want to let you know that my very good friend Brent Moores is hanging out in the chat with our live audience. He's going to be keeping an eye on any questions that come in. And if I can't get to those, Brent's going to be there to pick up my slack. Brent and I have now been working together for more than 20 years. So he brings a lot of experience to this discussion. Thanks for being there, Brent. Brent and I would also like to issue an invitation to everybody watching to follow us on social media. So you can follow Brent and me on X. You can find Brent there at Brent Moores CS. You can find me on X at Cameron May CS. And you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. I'll take you to my profile. You can give me a follow there. But let's get into this discussion. Now, as we do, of course, there are risks to be considered with any approach to investing or trading. So bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and diversification does not ensure profit and does not protect against losses in declining markets. All right, so let's get into today's discussion. We're going to set an agenda. What I wanted to talk about here, just to set what I think could be an important backdrop for today's discussion, is how 2026 has been proceeding so far. And there have been some fairly consequential shifts in investor behavior. Now, it doesn't mean that those are going to continue, but it might be interesting to observe nonetheless. So I'm going to look at a few charts to set the backdrop for what might be happening with dividend investing in particular. Then we're going to look for a new dividend investment candidate to be added to our example portfolio. And I want to show a different way or a new way that we might find those kinds of candidates. But before we're done, let's make sure that we've added a new position to that portfolio, all right? So let's go right to the Thinkorswim desktop paper money platform. And I wanted to start with what's going on with yields. So in this webcast series, we talk about dividends. Those are payments coming from a publicly traded company. Now, for an income investor, they might choose to buy equities and maybe get dividends, or they may look to something else to invest in, including maybe long-term government fixed income securities. So this is sort of the competition for our dividend investors. Sort of. That's the way I look. That's the way I frame it here. Not everybody sees it that way, but in any case, we can't have $1 in two places at once, right? In any case, let's see what's going on with yields. Yields, starting in late summer, early fall, had dropped below 4.2% on the 10-year yield. So if you're not familiar with this chart, it's symbol TNX, CGI, and it's a chart of 10-year yields. Anyway, yields had been falling as rates had been getting cut by the Fed. in reaction to that, in anticipation maybe to more. But starting here in October, we started to see a rise in yields, making those government-issued fixed income securities comparatively more competitive with fixed income, not fixed income, but dividend stocks. So we see the yields coming up, and potentially importantly got above the 4.2% level for the first time in several months, but that didn't hold very long. Just over the last week or so, we've seen a fairly significant drop in yields. Why do yields drop? Well, they might be falling in anticipation of additional Fed rate cuts. Why does the Fed cut rates? Maybe because the Fed and investors by extension might be a little uncertain about the economic outlook for the U.S. economy. So this may be a reflection of signs of weakness economically. Now that can have important implications for stock investors. So let's switch over to stock investing. Let's have a look at the S&P 500. The S&P has not gotten off to a stellar start to 2026. It's been very much an up and down performance in these first 5 or 6 weeks of trading. And really, if you look at where we opened trading and where we are right at this moment, we're actually slightly down on the year. So investor sentiment toward equities, it doesn't mean that we're seeing full market collapse in stocks. Really, I think that would be a strong conclusion to make from what we're seeing here. But there may be some hesitation. And I think with my audience of 176 live viewers at the moment, there's probably going to be some who might agree with that sentiment. Maybe we have some economic concerns. Now, it's not my place to say, yes, the economy is in rough shape, or no, the economy is strong, or to try to project exactly where things are going. But what we can do is look at investor behavior and try to extrapolate from that maybe a general view of the economic condition or the perception thereof. So, yeah, stocks not getting killed, not thriving, just kind of stagnating over these first 5 or 6 weeks. Now that's for stocks in general. Actually, there are some categories of stocks that are really struggling, and there are other categories of stocks that are comparatively thriving. So let's go look at the ones that are thriving. And specifically, going back to the start of 2026, dividend-paying companies have been having a great run. So let's have a look at this is a reflection. I'm just keeping an eye on things. I just saw, yeah, Cecil says, dang it. I think we may have just lost the feed here. Just sending a message to my producers. There we are. Back online. So I think that was just a temporary glitch. Good to see. Anyway, let's look at what's been going on with the S&P Dividend Monarchs Total Returns Index. And just to explain what this is essentially a chart of the S&P Monarchs. These are companies that have been paying, that have been increasing dividends for the last 50 years, but they're part of not the S&P 500, but required to be a part of the S&P 1500. And so these dividend-paying companies also have the potential for the price to go up. And so what this chart does is it takes the price movements of all of those companies, the dividend monarchs, there are about 50 of them, and then adds in the dividends they're paying. So we're seeing total returns here, not just price movement. And if you look right here, as we kick off 2026, as other stocks in other categories have been struggling, what's been going on with at least the monarchs? Even today, up a bit, when somebody says the stock market had kind of taken a dive over the last hour. Yeah, we've been seeing a little bit of fading in the monarchs, but even the monarchs are they're up net on the session when other stocks are down. So we're off to a pretty good start. Now, if somebody had said in January, this is the year of the dividend stock, so far, so good. Now, that's not a guarantee that that's going to be the same story come December 21st of 2026. But there may be a shift underway in investor sentiment. Maybe those falling yields, that might be an indication of a little bit of skittishness about the economic outlook. And so could there be a bit of a net migration from the more speculative portions of the market to the more quote unquote conservative, or let's say defensive sectors. Let's look at that. Let's look at that. I'm going to go even a little bit deeper now. I think you can see the premise of this discussion, but let's go have a look at some individual sector behavior. So here's a quick way that we can do that. We're going to be leaning heavily into the watch list. This is going to be our tool that we're going to be using to look at the markets and also to find an investment candidate for today. All right. So let's go to our watch list. Right now we're seeing the S&P 500. This is a public watch list that's maintained and published by Thinkorswim. But I'm going to switch this to right down here under the public watch list in alphabetical order to the sector indices. Now, how many of you have used this watch list before? This is really a breakdown of the 11 sectors that make up the S&P 500. Here they are. Now, they have kind of weird symbols. That's not unique to these sectors. Let me open this up a little bit. But lots of individual stocks have weird symbols. You can probably think of some right now, like Corning is GLW, okay? Even Google, we don't call it Google anymore, it's Alphabet, but GOOGL is actually Alphabet's trading symbol. You get the point. You can't always tell the company or the underlying based on its symbol. So one thing that we can do here on our watch list is put in a custom column. Now, one thing that I will say, if we just click on a symbol and then we minimize that left column, we can see which sector is being displayed right there. But if we have the left column open, that kind of gets crowded out. We can see the S and that's about it. So let's do this. Let's come here where we can get our customized columns, little gear icon. I'm going to click on that. Let's choose customize, and I'm going to add the security or the index description. So we're going to add that. How about we put that right next to the symbol and click OK. And what this does, as we expand this out a little bit, is we can see which sector is being displayed. And I don't really care for this discussion about the market capitalization of these individual sectors or the last trading values. That's not what I'm looking for. But instead, I want to see the charts for each. So now that we have the description, we know what the symbol, which sector that symbol aligns with. And I want to have a look at what are traditionally known as the defensive sectors. So if the concept here is that in 2026, investors are becoming more defensive, we should see a reflection of that in the behavior of the defensive sectors. So which sectors are considered traditionally to be defensive? Well, they're usually three. Usually staples, usually healthcare, and usually utilities. Now, not everybody sees all the sectors in the same light, but how about we have a look at what's going on with staples to start things off? Okay. Chibukanda says, can you kindly help me how to add a few trading days to the right? This little white space over here, yep, that's known as the right expansion area. So these little arrows right there are used to manipulate that. So if I click on that and I change the right expansion, you can add extra bars or days right here. So I have 15 of extra bars. That's it. So when you make your selection, just click apply and then click OK. So hopefully that's helpful for you. But what's going on with staples right now? Do you see anything that maybe stands out? Yeah, staples have really blasted off. They have really contributed to the performance of the dividend monarchs, that total returns chart that we just saw. But another way that we can view this, we can just look at this, but we can look at the chart, but that doesn't necessarily mean that that's happening independently of or even faster than the S&P 500. So let's add a comparison chart. I'm going to come up here to our little flask icon, and I'm going to add what's known as the relative strength. What we're doing here is comparing the sector to see if it's relatively stronger or weaker than the S&P 500. So let's choose relative strength from our menu, add that to our chart, and you'll notice here it says relative strength compared to the S&P 500, SPX. If we click apply and click OK, we're left with this blue line. So here's the interpretation of this. If you're not familiar with the blue line, there's also a red line. The blue line basically just tells us that, well, if the blue line is going down, it means that our charted symbol up here, in this case, it's the staples sector. I would interpret this blue line to mean if the blue line is going down, staples are relatively less strong than the S&P 500. Now you might say, well, yeah, because staples are going down, the blue line's going down. Nope. Sometimes the S&P can be going up and staples can also be going up, but if staples is not going up as fast as the S&P, what direction will our relative strength line be going? It'll be going down. It literally translates to, is the sector here overperforming or underperforming, outperforming or underperforming the S&P 500? So yeah, since at least back to April, and actually if we were to look at this on a multi-year view, this sector has been underperforming the S&P for a long time. But what some investors will look for as they're looking at the relative strength is for a change in its behavior. And you'll notice relative strength has been going down and down and down. We have the staples just underperforming month after month after month, but just early in 2026, we've started to reverse that trend. That's interesting. Let's flash over, see what's going on with healthcare, another one of our defensive sectors. That actually began an outperformance sort of recovery period back in late September. And you can see that somewhat reflected on the chart, but again, the chart can be deceptive. Because if our chart is going up, but not as fast as the S&P 500, it may lead the investor to the wrong conclusion, which is, ooh, here's a strong sector. No, it can actually still be relatively weak if everything else is relatively stronger. So we had a shift in healthcare that's now been going on for not just the first part of 2026. This one started maybe a little bit of a consolidation here, but a nice run starting back there in September. Now, finally, let's see what's going on with utilities. And utilities looks kind of similar. We could have drawn this line from back here, but even more recently, a significant underperformance versus the S&P 500, but just starting to see that shift, and you can kind of see utilities taking off. Now, with each one of these, even if we aggregate all this evidence, does it mean that investors are certainly defensive, absolutely for the longer term? No, it doesn't mean that. We never know exactly what the future holds, but it still might be interesting to those that are just trying to get their fingers on the pulse of how everybody else is behaving to observe, wow, there seems to be a shift in behavior that wasn't here before. So let's take a look at our example portfolio as it's currently constructed, and we're going to use this information just as a backdrop for an investment decision today, okay? So let's go to our monitor tab. Let me hide the left column again for a moment. Here's our current portfolio of dividend stocks that we, interestingly enough, started building at the start of 2026. This is pretty new webcast series. I've only been doing this for 5 weeks. This is the 6th. So we've accumulated a bit of a portfolio. So what we're doing here is we're managing in an example $200,000 portfolio, putting 5% into each of the dividend stocks that we're adding into that portfolio. So a diversification model is being employed here. Now, as we discussed earlier, diversification is not a guarantee of performance, but we've spread this across a range of sectors so far, and I think we're going to continue that pattern today. But so far, we're about 25% invested. 5% each in 5 different holdings is 25%. Still have plenty of money to spend. We already own some utilities. We already own some consumer staples. There is one of those defensive sectors that doesn't have representation in our example portfolio yet. How about today, let's look for a healthcare stock. That was the one that had a little bit more strength going back all the way to September. Now, for some investors, they like to spread their dividends across a range of payment cycles to try to do what we call a dividend ladder. Like maybe they like their dividends, they like some of them to pay in January, some to pay in February, some to pay in March, for a more consistent payment schedule. That's going to be a potential priority for our portfolio, although I don't think it's going to ultimately be a huge emphasis. Now, yield, though, has been emphasized in our example portfolio. Right now, our average yield is about 4.25% versus the average yield on an S&P 500 dividend-paying company of about a little bit over 1%. Our beta is something we've been keeping an eye on. Beta is a measure of volatility. Values less than 1 indicate that this is a stock that's less volatile on average than a typical S&P 500 component company. So we have, on average, lower volatility, on average, higher yield. We have our dividend payout ratio and our long-term debt are measures of potential risks to the ongoing payment of dividends, although with each of these companies, they have extended track records of paying and increasing dividends on an annual basis. Next up, we have our trade price, which is nice. The current market price of those purchases, also fine. It's not that we're in this to make short-term returns. These are investments for the longer haul, but we will be making adjustments in the future, possibly the distant future, depending on the performance of these individual companies. You might think, oh, does that mean if one of them starts to fall, we're going to sell it? Nope. If one starts to fall, if it's still paying its dividend, we're going to add to it. Yeah. The objective here, we're attempting to have and maintain diversification. Now, just because something happens to go through the ups and downs of sort of normal stock price behavior doesn't necessarily mean that an investor cuts it loose and replaces it. So the plan here is if any of our securities drop by more than 20% in value, we're going to add to those to rebalance the portfolio. On the other hand, if something really blasts off, that's great, but we're going to shave those back, bring those back into balance. If anything takes off and goes up by more than 60%, so we're going to allow some upside, but we'll probably scale that down. Eva says buy on dips. Yeah, Barbara says, why would you sell one? So Barbara, for our example, dividend portfolio manager here, the reason to cut loose a dividend-paying company is if it happens to cut or remove its own dividend. That's going to be our reason. Otherwise, it's just rebalancing. So how have we been doing so far? Well, pretty good start to 2026. We have one that's up 15%. Our worst performer is Prudential, which we really, if I click on this, let's click on the quantity. You can see we've owned this now for exactly a week. All right, so it's nice that that's up 3%. But overall, portfolio is doing very well. What sort of message might that send about the performance of dividend stocks in 2026 when we just saw how a broader portfolio, represented by the S&P 500, has been doing? Dividend stocks are having a great year. We'll see if that continues. But we're going to add to our portfolio. Our priority for today is to add some more diversification. Let's look for a healthcare company paying dividends. So how do we find those? Well, let's go back to our charts. And I'm going to take off this relative strength. We've already done that sort of sector breakdown. So let's come up here to our little flask icon and click the X to remove relative strength. Click Apply. But as we go to look for a healthcare company, just the fact that it's a dividend payer in the preferred sector doesn't necessarily mean we're going to invest right away. We do have some example priorities. So let's put ourselves in the shoes of that theoretical dividend investor. And here's a list of potential portfolio priorities. Now, this is not intended to be exhaustive. It is not intended to be the list, but I think it might be a serviceable list to stand in as our to allow for discussion about what sorts of things a dividend investor might be looking for. Now, obviously, yes, we're looking for yield. That's the point. We've stated a preference for diversification. Not every investor requires, let's say, a huge range of diversification across a spectrum of sectors. We're going to in this webcast. Now, we may have concentrations a little bit more weighted in some sectors versus another, maybe due to long-term outlooks, but diversification is going to be a point of emphasis. Consistency, and I'm talking about specifically consistency of actually having a track record of paying and increasing dividends. That's going to be a point of emphasis. Debt and volatility may be seen by dividend investors as potential threats to their portfolio while they're waiting for their dividends to be paid. But we will also be looking at combined total return performance, price plus dividends. And finally, yes, payment schedule. If we can ladder those dividend payments, but not at the expense of, let's say, stronger diversification or higher yields, we may choose to do that. But those are going to be our example priorities for this portfolio. So let's go look for companies that may suit these priorities. And we're going to do that again using a Thinkorswim public watch list. So this is something we haven't done before. I'm going to go up to the watch list and switch this from the sectors to go right here to public, to through F. And right here are lists of companies that have been paying dividends for 25 years or 50 years. Those sound similar to aristocrats and kings. These are not explicitly dividend aristocrats or kings. The requirement for those being increased dividends every year for 25 years. And specifically for the aristocrats, they also have to be a member of the S&P 500. I'm just going to look at this 25-year dividend. These are companies that have paid at least a consistent dividend for 25 years, sometimes increasing. And we're probably going to recognize a lot of these companies. Now, the next thing I'm going to do, I'm going to remove this description. We'll be able to figure out who these companies are. Let's customize our column set a little bit. So the first thing we'll do, let's take the description off. And a few customizations. How about we add, well, let's do it according to our priorities here, yield. What's a column that might address that? Well, how about just yield? So let's add yield. Let's, for the purposes of diversification, add the sector. For consistency, well, that's the 25 years. Debt, let's just type in the word debt, and we have the long-term debt to capital value that we've been keeping an eye on. Let's select that and add that. Volatility, we'll still use beta as our gauge of volatility. There we go. And performance, we're gonna review using a chart. So there we go. This is our example list of, it's our custom column set. Let's just click OK. And then I'm also going to detach this. Let's detach the gadget. It allows us to look at this through kind of a wider field. And maybe I'll do a little bit of moving around a little bit because I want to make space for us to see the sector while still seeing. Let's move this over. There, our sector. And what I want to do is let's just sort this by sector. We can just click up at the top, just have them in descending or ascending alphabetical order. It doesn't matter which. So Barbara says, what if a sector starts to fail, especially, meaning price goes down, right? Especially if you've spent all your money in your account. Now, the management of a self-directed portfolio is always left to that individual to decide. However, this is a webcast series dedicated to investing and not to trading. And those are two very different approaches to the management of a portfolio. An investor recognizes that stocks rise and stocks fall. They may use those sector cycles that maybe have a little bit of shifting between their points of emphasis for different sectors. For example, if they think that a sector's been out of favor for a long time, and they think maybe it's going to go through a multi-year growth cycle, maybe instead of having two stocks in that sector, they may have a third stock. Maybe they'll have one fewer stock in another sector where they don't see as much potential. But generally speaking, we're not going to be making massive changes to this portfolio. We are going to be talking through important potential considerations for dividend investors and adding to the portfolio as we see fit. Okay. Maria says I have to play this slow or invest in a monitor. Yeah, sometimes you have to go back and rewatch these webcasts. That's okay. These are scheduled to be archived. This series is being recorded. It's being posted to our YouTube channel. So if you haven't done that already, make sure that you, first of all, subscribe to the Trader Talks channel on YouTube. So you can just pop down below the video, click on the subscribe button. It only takes a second. It doesn't cost anything. But then you can join our live streams here. You can find our playlist right here. If I were to click on playlists, this webcast series is going to be right here at the top, investing in dividend stocks. You can find the full playlist right there. And you can see other discussions that we've had. But back to, that's not what I want. Hold on a second. I accidentally pushed play there. I don't need to push play. Let's back out of that. Let's close that up. And I'm going to take us right back to the home page for the channel. There we go. But let's start to look now. Let me move this over a little bit. We don't need quite that wide of a gadget bar at this point. But let's bring up our watch list and let's scroll on down to the healthcare companies that have been paying dividends for at least 25 years. I'm just going to move the rest of these out of the way so we just have our focus here on healthcare. So you'll notice there are only 7 companies in that healthcare sector that have paid dividends consistently for the last 25 years. And as we look at those through our other lenses here, let me make sure I got everything in here that I wanted to. Yeah, we have our sector, we have our yield, we have our, yeah, that's good. Let's see, Maria says, is there a way to save this chart for dividends and still be able to use other charts for other videos? Yes, Maria, if we're doing this on our live platform. So I'm doing this on paper money. But on a live platform, you can actually save your watch list layout. Yep, there's a little function that it shows up right up here. You can give it a name and save it, and then you can just switch back and forth. That hasn't been added to paper money. Maybe I'll say yet. I don't know if it's actually coming, but we'll see. But yep, that's how you might do that. Anyway, but let's look at our healthcare. And what I want you to help me do is select one of these. So there's one, CAH, paying a 0.9% yield. That's actually a below average yield. Some investors might be totally fine with that. WST, also below average yield. Yes, with some companies, even if they've been paying a dividend for 25 years, even if they've been increasing it, maybe they've only been increasing it a little bit while the price is taking off. So the yield has become relatively low compared to price. That's a possibility. But there are a few here that might be, let's say they're early standouts. MDT paying a 2.8% dividend. We have ABBV, 3.06% dividend. And how about we throw in J&J, another great big company. So these are among the largest. We have ABT up there. I don't know, maybe we could look at that one as well. But Sunit, I'm already getting votes. One person says none of these on the list. That's okay. Individual traders or investors might have their own preferences. But should we start at how about we start at the lowest yielder? Now, low yield isn't yield itself is not the sole objective for this example portfolio. We actually look at total returns over an extended period. So let's bring up a long-term chart here. Let's go to a 10-year weekly chart, and we're going to adjust our chart settings. Let me click here. I'm going to go to equities because we're talking about stocks or equities. And then right here where it says adjust for dividends, I'm going to choose all. So what this does is it takes the price chart and it adds in the performance of all of the dividends that have been paid over the last 10 years. So that can significantly change the view of the total return performance of that equity. So let me click apply and click OK. And let's have a look here first. Let's bring up our watch list again. And I have these linked. So I've selected one here. I've selected one right there. And so when I click on one of these, like, let's see, we're going to look at Johnson & Johnson. J&J. There we go. Here's what J&J has been doing. Now, for a pure price investor, this was not the sexiest stock for about the better part of, half a decade, 5 years, just sort of chopping sideways. And this included all of these dividends that were being paid. So you take out the dividends, this thing was probably working its way downward. But price has really started to catch fire. Now, this could burn out. We don't know. Could this introduce a new level of risk to the investor? That's a possibility. Could be a consideration. So what else does it have going for it? So it's on the low end for yield, but still roughly double an average yield for a dividend-paying company in the S&P 500. It's in the sector that we're targeting for today's example. It actually carries a comparatively lower amount of long-term debt relative to capitalization, and it is a low beta stock. Despite this move to the upside, just a directional move doesn't necessarily mean that this is a highly volatile stock. It can make a directional move in small daily increments. Long Snapper says, why do it this way when you shouldn't rely on principal when looking for income? Oh, so you're just talking long Snapper. You're saying, why are we looking at the chart when for some they don't care? That's a totally valid observation. And for some investors, they don't care about long-term performance of price, but others do. So just as always with these demonstrations, we can take what's being demonstrated and tweak it to whatever seems appropriate for that investor. And of course, none of what's being demonstrated is simultaneously being promoted. I'm not trying to convince anybody to do anything in a given way. It's just an example of how it might be done. Anyway, so there's Johnson & Johnson. Take a look at these metrics, take a look at the chart, take a look at the yield. All of these things may play a role in the decision of the investor. So next up, how about we go to number 2 in yield, which is MDT. Actually, I said Abbott also. Let's click on that. Here's what's been going on with Abbott. Here's these notes. Don't worry about that. That's for a different webcast series. Abbott had a strong total return run here, a pretty good sell-off at a time when a lot of companies were selling off. It's had a pretty strong recovery. Most recently, it's been a little bit softer, but net, left to right, this is up many multiples over a 10-year stretch. It also has comparatively light long-term debt, little bit more volatile than Johnson & Johnson on an average daily basis. So let's look at our other ones. And what I'll do at the end of this is I'll throw out a request. You chat in the symbol that you think that we should invest in, and we'll go with the first symbol to get 3 votes. But don't vote yet. Wait until I say go. All right, so next up we have MDT, 2.81% yield. Long-term debt, 3.55. These are now, remember, across different sectors, it may not be terribly meaningful to compare long-term debt or other debt measurables. Within the same sector, it might carry a little bit more weight. Nothing's a guarantee, of course. Our beta, it's kind of mid-range. All of these are falling under 1. So these are lower than average volatility stocks. And finally, we have ABBV. This one seemed like it was an early favorite. Let's see if that holds as we click on this. Just shy of 3.1% yield. A little bit heavier long-term debt load. Pretty low beta. But this one up basically tenfold over the last 10 years. It's certainly not guaranteed to do that over the next 10, but it does at least have that strong track record of paying dividends. So what do we think? Go ahead and make your vote. So I'm going to throw out 4 potential candidates. To review, it's going to be ABT, MDT, ABBV, or J&J. And to try not to sort of poison the well too much, I'll bounce around among these just so you can get another look. So, okay, so you see 1 vote for J&J. We have 2 votes for ABBV. We have ABT. Oh, look at that. J&J sneaks in the back door. Okay. So we had a couple of votes for ABBV, but J&J was the first. Just got there to get 3 votes. So we're going to be buying some shares of J&J in our example portfolio today. Let's do it. Let's go to our trade tab. Let's make our investment in J&J, bringing in some of that healthcare defensive positioning. Let's click on the ask price. And in this portfolio, as I mentioned early in this webcast, we have an example portfolio of $200,000. Just a paper money portfolio. We're investing 5% into each stock. So that's $10,000. So this is a $244 company. To buy 10 shares would be about $2,440. To buy 40 shares is going to get us right there. Let's be a little bit more precise than that. Let's get out our calculator. And if we have $10,000 to spend, let's divide that by 244.68. Obviously, that price is not a guaranteed fill price, but it's going to be close enough for this. Yeah, 40 shares. So let's buy 40 shares. And as I'm going to do each week, I'm going to change this to a market order. Obviously, a market order carries some risk with it. When we submit a market order, we're just subjecting ourselves to the whims of whatever the market decides we need to pay. Okay, so it might be 244.66 or 67. Could be more, could be less. Let's click confirm and send. Buying 40 shares of J&J at the market price. There's no commission on this investment, but there can be on some types of trades. Let's send this order off and let's see what we fill for. Order is working. 244.67. All right, perfect. So we're in, guys, and we have accomplished what we set out to do today. When I kicked off this webcast, I threw out the question. Obviously, there's a question that nobody can answer at this point, but will 2026 be the year of the dividend stock? So far, so good. We'll see where we go from here, but we'll keep an eye on this portfolio. We'll keep adding to it. We'll make adjustments as or if those seem necessary. But I hope that you'll be following along with me. I think this is going to be a fun discussion. I like the take that we're using for this series. It's all about investing. So guys, thanks for giving me your time today. We'll do this again next Thursday. You can always catch up on a webcast archive if you miss things. So as a quick reminder, if you haven't subscribed to our Trader Talks channel on YouTube yet, go down below the video, click on the subscribe button. It only takes a second, doesn't cost anything. But our Trader Talks channel is where you can join our live streams. You can also find our playlists right there. If you want to find the playlist for our Investing in Dividend Stocks series, it happens to be right up at the top. As I've said before, I think they did that to compensate for putting two of my other webcast series all the way down at the bottom. But another thing that Brent and I would suggest you do is to follow us on social media. You can find Brent and me on X. You can find Brent on X at Brent Moores CS. You can find and follow me on X. Here's my handle on X, at Cameron May CS. This is the guy you're looking for on the platform. But I'm very active on X, and if you reply to one of my posts, I just try to reply right back to you as well. And it allows for interaction when the camera's not on. It's not only is social media the best place to connect with me in between the live streams, it's the only place to connect with me in between the live streams. So you can find me on X, or you can also find and follow me on LinkedIn. Let me bring up my LinkedIn. There we are. So I just started my LinkedIn journey a couple of months ago. 224 people following me, and you can see I post here. If you reply to my posts, I just try to reply right back to you. All right, everybody, thanks for giving me your time. I will look for you in a future webcast in this series or in my other series. I didn't see a survey, but always if there is a survey, if you take time to fill those out, that's always appreciated. Thanks for all the thumbs up on the video. I can see 160 people watching the live stream right now. 61 have clicked that thumbs up. That's always appreciated. It sounds like applause to your presenter. That's how we receive that. But also, it gives my video a boost in the YouTube algorithm and helps more people find these discussions, so they can learn things about investing and trading concepts, including this potentially significant shift that seems to be going on. We'll see if it continues. Make sure that you watch in future weeks. But Brent, thanks for helping out. I will see everybody in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.